Welcome back to the deep dive. So you're looking to play the long game in crypto, right? Thinking 5, maybe 10 years out with your hodling strategy.
Yep.
And you want to cut through all the noise, figure out how to actually pick potential long-term winners, not just what someone else is hyping.
Exactly. And that's smart because, the whole eeping into moonshot projects blindly, that's getting riskier as the market matures.
Right.
For that kind of 5-10 year horizon, you really, really need to dig into the fundamentals. Do the work.
Okay, so let's do that work. Before we even talk specific coins, what does deep analysis even look like in crypto? It's like fundamental analysis for stocks, but different.
Yeah, pretty much. You're looking at the core value, but with a blockchain twist. So
Yeah.
first up, market capitalization.
Market cap. Okay, just a big number, right?
Yeah.
Or is there more to it?
Well, it tells you about size and maybe stability. It's the price per coin times the circulating supply. Simple enough. But
Okay.
here's the key thing. You got to check the fully diluted market cap, too.
Okay.
If there's a huge gap between that and the current market cap.
That means a lot more tokens are scheduled to be released later, which could dilute the price, push it down.
Ah, okay. So more supply coming online.
Exactly. You look at giants like Bitcoin, over $1 trillion market cap in 2025, Ethereum over 200 billion. They're seen as more stable, kind of like blue chips.
Right. The big ones.
So the question for you is, are you after that relative stability, or are you willing to take on more risk for potentially explosive growth with smaller projects?
Makes sense. Okay, what about trading volume and liquidity? If I'm holding for 10 years, why does today's trading volume matter?
Great question. Because high, consistent volume shows real investor interest. And crucially, it means there's liquidity.
Liquidity, meaning I can actually sell when I want to.
Precisely. Exit liquidity. Imagine your investment does a 10x over 8 years. Fantastic. But if there's no one buying, or very few buyers, you can't actually sell your position without tanking the price yourself.
Right, your own selling drives the price down before you're out. Exactly, especially with newer, low liquidity coins, you might not get anywhere near the price you see on the screen. So it's not just about getting in, it's about being able to get out smoothly later.
Okay, critical point. Beyond the numbers, what about what the crypto actually does? The use case.
This is absolutely fundamental. The rubber meets the road here. What problem does it solve? Is it realistic?
Like Bitcoin being digital gold.
Yeah, its value comes from that security, the limited supply, its reputation. For any project, you have to ask, is the use case real? How many people actually need to use this thing for it to be sustainable, to cover its costs?
So it needs a real reason to exist beyond just speculation.
100%. If it sounds vague or just way too ambitious with no clear path to real users, that's a huge red flag for long hold.
But who's building it? The team, the community. How important are they?
Oh, incredibly important. Just like a company's management. You want an experienced, transparent team. Can you find them on LinkedIn? Do they have actual blockchain experience? Is their activity visible, like on GitHub?
Not just anonymous avatars.
It's definitely not. Anonymous teams, or teams with zero track record. That's a major risk. Think of scams like that Squid Game token. You gotta ask, can this team actually deliver on their promises over 5 or 10 years?
And the community.
A strong, engaged community is a great sign. People discussing technicals, suggesting improvements, demanding transparency, like Ethereum has.
Okay.
But watch out for communities that are just, speculators shouting, "Win Moon," or people just farming quick rewards. That usually means heavy sell pressure down the line.
Right, not sustainable interest. Okay, let's go deeper into the economics. Tokenomics, how the token itself works, and if the project actually makes money.
Super important. You need to look at the vesting period when early investors or the team can start selling their tokens, and the emission schedule, how quickly new tokens are released. Both affect potential dilution.
Just like a market cap earlier.
Exactly. And then the project's actual financials. Revenue, expenses, profit, how much cash or crypto they have in their treasury.
How do you even find that for crypto projects?
It can be tough, requires digging, but look at examples. Uniswap, the exchange, generated huge fees in 2022, like $800 million. But its protocol revenue was zero.
How? Where did the money go?
It all went to the people providing liquidity. Now, Uniswap could turn on a fee switch to take a cut for itself, but it hadn't.
Interesting.
Or take Lido, the staking provider. It had $32 million in protocol revenue, but a net loss of $73 million after paying out token incentives.
So revenue isn't profit.
Not at all. You need to understand the difference between total fees generated, what the protocol itself actually keeps, and whether it's ultimately profitable and sustainable. It's critical for the long term.
Okay, last foundational piece. Security and regulations. Huge
Yeah.
topics.
Massive and often linked. Security breaches. They often happen because of human error or code flaws, not usually the blockchain itself. A good project should have outside security audits, bug bounty
Things
programs.
to show they're taking it seriously.
Right. If a project dismisses audits or lacks transparency, run away. Enter regulations. You just can't ignore them. Taxes apply, anti-money laundering laws apply.
So you need to know the rules in your country.
Absolutely. And you need to know if the project is trying to comply or just ignoring it. Ignoring regulations is not a viable long-term strategy. Have you personally checked with a tax advisor or lawyer familiar with crypto in your area? It saves massive headaches later.
Okay, fantastic groundwork. We have our toolkit. Now let's apply it. If you're looking for those lower risk, blue chip type crypto holds for 5, 10 years, where do we start? Bitcoin, obviously. The OG.
Bitcoin's the natural starting point. Launched 2009, oldest, biggest, most well-known, over $1 trillion market cap in 2025. Seen as that inflation hedge, the digital gold.
Based on its security and limited supply.
Exactly. That hard cap of 21 million coins, minting stops around 2140. Plus, it's a decentralized network. It's even mentioned in the U.S. government's Strategic Crypto Reserve Plan.
That's significant institutional recognition.
It is. And what's really interesting now is seeing how it interacts with traditional markets. There's some evidence investors are actually using it as a substitute for physical gold sometimes. And the US dollar strength. It often has a bigger negative impact on Bitcoin than even on gold.
So it's getting more intertwined with the wider economy.
Definitely seems that way. The main con, if you will, is that Bitcoin wasn't built for dApps or NFTs directly. It's primarily focused on being that secure store of value.
Okay. Then the other giant, Ethereum, the ecosystem king.
Yeah, Ethereum. Launched 2014, it's the dominant platform for NFTs for DeFi. Buying ETH is often seen as a bet on Web3 itself, on a decentralized internet.
And it's trying to scale with layer twos.
Right, solutions like Optimism and Arbitrum are helping handle more transactions faster and cheaper. Plus, its tokenomics are interesting. They burn a portion of transaction fees.
Meaning the supply can actually go down.
Potentially, yes. Which could be bullish for the price long term. Like Bitcoin, it's also slated for that U.S. strategic reserve, and it got those ETFs approved in mid-2024, opening the door for more institutional money.
What are the downsides or risks for Ethereum?
Competition, mainly. Lots of other blockchains like Solana, Cardano, Polkadot are trying to eat its lunch. It's also faced criticism for high transaction fees at times, and its price growth hasn't always kept pace with some rivals recently.
Okay, so Bitcoin and Ethereum are the low-risk anchors. Let's move up the risk curve a bit. Moderate risk, but still solid fundamentals. Where does Solana fit in, the speed demon?
Solana's a big one here. Really fast-growing smart contract platform, number 6 by market cap recently. And yeah, its price growth has outpaced Ethereum at times. Its speed is incredible, thousands of transactions per second, potentially millions with upgrades like Firedancer.
And it's user-friendly, cheap fees.
Yeah, that's attracted a lot of users and developers. It's also in that U.S. strategic reserve list. The main knock against it, the big question mark for long-term hodlers, is centralization.
Because fewer validators control a large chunk of the network.
Exactly. About a third of the top validators control over 35% of the stake. Critics argue it sacrifices too much decentralization for that speed. That concentration of power is a potential systemic risk.
A trade-off to consider. Okay, what about Chainlink? Link, the middleware.
Chainlink plays a unique, vital role. It's a decentralized Oracle network. Basically, it feeds real-world data securely onto blockchains so smart contracts can use it.
Like for insurance triggering based on weather data
Or verifying identity, tracking supply chains, powering decentralized betting markets, anything needing off-chain info. It has amazing partnerships, Euroclear, BNY Mellon, Swift bridging traditional finance and blockchain.
Wow.
Over 2,300 partnerships, huge transaction value enabled.
Sounds crucial. What's the risk?
Competition again. Other projects are building their own oracles, and like some others, its price peaked back in 2021 and has been a bit stagnant since. So questions about future growth potential relative to the market.
Got it. Then there's Cardano, ADA,
Yeah.
known for its slow academic approach.
Yeah, Cardano prides itself on using peer-reviewed research for everything. It aims for high security and lower fees by building tokens and NFTs directly on Layer 1. It has low inflation heading towards near zero by 2050, and it's also on that U.S. reserve list.
But the slowness is the drawback.
It's the trade-off. That peer-reviewed approach means upgrades take longer. It lagged behind competitors in getting smart contracts fully functional, which slowed down adoption and ecosystem growth. Rigorous, but maybe not nimble enough for some.
Polkadot, DOT, the Internet of Blockchains, aiming for interoperability.
Exactly. Polkadot lets different incompatible blockchains talk to each other. It also lets people create new specialized blockchains called parachains, all secured by the main Polkadot network. Some see it as foundational for Web3.
And it's fast through those parachains, offers good staking rewards.
Yep, up to 1,000 TPS via parachains and staking rewards over 11%. The main concern for long-term holding is DOT's inflation rate, which is relatively high at around 7.78% per year currently. That can potentially erode value over time if demand doesn't keep up.
Okay, Avalanche, AVAX, another fast layer 1.
Yeah, Avalanche launched in 2020, supports NFTs, DeFi, and it's EVM compatible, which is a big plus, easy to move stuff from Ethereum.
And it has a limited supply, burns fees.
Right, capped supply at 720 million and fees are burned, reducing supply. It uses a unique consensus mechanism called Snow for Speed, around 45 TPS, and has subnets for custom blockchains. They're pushing hard with developer grants and even a Visa partnership for a card.
Downside.
Similar story to Chainlink and others, some price stagnation after its initial big run. Something to watch.
Lastly, in this moderate tier, Binance Coin, BNB, tied to the big exchange.
BNB has tons of uses within the Binance ecosystem, paying fees, token sales, powering the Binance Smart Chain. It's super liquid, and they do regular token burns to reduce supply, aiming for 100 million BNB eventually.
But the centralization risk is the big one here.
Absolutely. Its utility is undeniable, but it's all built on Binance, a centralized entity. That comes with regulatory risk, as we saw with Binance's legal issues and BNB's exclusion from that U.S. reserve list, for example. Investing in BNB is basically a bet on Binance navigating those risks successfully long-term.
Okay, that covers the moderate risk zone. Now, for those feeling adventurous, maybe with a smaller part of their portfolio, the higher risk, higher potential plays, the moonshots, but with big warnings attached.
Exactly. And let's be clear, this is where things get really interesting, but also really risky. Forget 1,000x on Bitcoin from here, the market cap's too huge. That kind of potential usually lies with much smaller, newer projects.
Which means they're less proven and have a much higher chance of failing completely.
Precisely. Scams are more prevalent here too. You have to be incredibly careful, balance that potential reward against the very real risk of losing everything you put in. Extreme due diligence is non-negotiable.
Understood. So first up, SUI Network, SUI, a newer layer 1.
Yeah, SUI is built by Miston Labs, aiming for high scalability and speed using the Move language like Aptos. It's positioning itself as a competitor to Ethereum, Solana, etc., focusing on DeFi, NFTs, gaming.
Potential is taking market share. Risk is. It's new.
Basically, its potential lies in its tech potentially offering real advantages. The risk is it's still very early, small ecosystem, unproven long-term adoption. It needs to lure users and devs away from giants, which is a massive uphill battle.
Toncoin, TON. The Telegram connection seems huge.
It's potentially enormous integration with Telegram's 800+ million users. That's a built-in distribution channel few cryptos have. Telegram making mini apps use TON Connect could drive massive adoption, letting people send TON easily in chats.
What's the catch?
Well, its fate is heavily tied to Telegram's strategy and regulatory standing. Any issues there could hit TON hard. Plus, it's community-run now after Telegram's SEC issues, which adds some governance uncertainty.
Hyperliquid HYP. Made waves in 2024.
Yeah, Hyperliquid is a layer 1 designed specifically for an on-chain financial system, aiming for a DS experience like a centralized one. It saw huge growth, nearly 10x, showing strong product-market fit, especially in derivatives.
The risk.
Centralization again, and quite starkly. Around 78% of staking power is with just a few entities. For something aiming to be a foundational financial layer, that's a major concern regarding resilience and censorship resistance.
Treasure DAO. Magic. Focused on Web3 gaming.
Right, Treasure DAO is building a whole gaming and metaverse ecosystem, even its own layer 2. The Magic token is the currency across its games, meant to be deflationary, used for governance. They're also working on an AI launchpad for games.
Potential is the growth of Web3 gaming itself.
Exactly, but the risk is clear from its price history. Magic is way down from its all-time high. The whole NFT gaming sector got hit hard and recovery's been slow. It's a bet on a very specific, still very speculative sector really taking off.
And finally, AAV, big player in DeFi lending.
IA is a cornerstone of DeFi on Ethereum. Lets you lend and borrow crypto without banks. If you're bullish on DeFi's future, Aave is a solid, established name in that space.
But DeFi itself has risks.
Absolutely. Smart contract bugs or exploits are a constant threat. There's impermanent loss risk if you provide liquidity. And platform hacks or failures are always possible in this newer space. You need to understand these specific DeFi risks.
Okay, phew. We've covered a lot of ground on evaluation and specific coins. But picking candidates is one thing. Actually holding for 5, 10 years through crypto's craziness, that's the real challenge. How do you navigate that? We know it's volatile.
It means preparing mentally to ride out the highs and lows. Seriously, this market can swing wildly. You have to be honest with yourself. Can you stomach seeing your investment drop 50%, 70%, even more without panicking? If not, or if you can't afford to lose that money, long-term crypto might not be right for you. Never invest more than you can afford to lose. That's rule number one.
And it's not set it and forget it, right? People think long-term means passive.
Huge misconception in crypto. Even top projects can have massive drawdowns. Just holding passively might mean you write it all the way down. Understanding market cycles, taking profit strategically, even cutting losses sometimes, often beats blind holding. You need to stay engaged. Revise your portfolio, maybe quarterly at minimum. Keep track of trends. Crypto rewards active, informed investors.
So how do you stay informed and avoid just reacting to hype or fear?
You need a strategy rooted in fundamentals. Why did you buy this project in the first place? What's its utility, its team strength, its tokenomics? Write it down. What would make you sell? What's your timeline? Having that thesis helps you make decisions based on conviction, not just market noise or what Twitter's screaming about. Treat it like a venture capital bet, expect volatility, focus on the long-term story.
And don't forget the boring but crucial stuff,
Yeah.
taxes and regulations.
Absolutely critical. Crypto profits are taxable, usually as capital gains when you sell or trade. Ignoring tax laws or anti-money laundering rules can lead to massive penalties. Get professional advice specific to your location. Don't guess.
Finally, keeping those long-term holdings safe. Security.
Non-negotiable for hodling. Get a hardware wallet ledger, Trezor, something similar. Keep those private keys offline, away from hackers. And be paranoid about scams. Pump and dumps, rug pulls, fake websites, phishing emails, even AI deepfakes trying to trick you.
Do your own research. Trust no one implicitly.
Exactly. If it sounds too good to be true, run. For larger investments, check the security practices of any exchanges or custodians you use. How do they manage keys? Do they have insurance, independent audits? And maybe consider the environmental angle too. Proof of work versus proof of stake, if that matters to you.
Wow. Okay. That was a genuine deep dive. We've covered the AZ of evaluating crypto for the long-haul market cap, utility, team, tokenomics, security. We looked at examples from the safer bets like Bitcoin and Ethereum through the mid-tier contenders like Solana and Cardano, right up to the high-risk, high-potential plays like Sui and Toncoin, and crucial tips on actually managing that long-term hold.
Yeah, hopefully this gives you a really solid framework. Remember, none of this is financial advice. It's a toolkit for your research. The market changes fast, but building real value takes time. Being informed is your best defense and your best offense.
So the big picture here. We see crypto evolving, getting tangled with traditional finance, Bitcoin acting like digital gold. It suggests a future where these digital assets are deeply embedded in the economy. The provocative thought for you is, how might this change our whole idea of value and investment over the next decade? And maybe more importantly, what role will you choose to play in that unfolding story?